This is a timeline of the S&P 500 options market on April 9th, 2025. Right here, at exactly 1 p.m., an anonymous trader executed a highly specific bet. They purchased 5,105 call options on the S&P 500. This position was structured to profit only if the entire stock market surged upward within a matter of hours. Exactly 18 minutes later, Donald Trump unexpectedly announced a 90-day pause on his sweeping global tariffs. The S&P 500 immediately exploded upward, gaining 9.5% in a single day. It was the largest single-day gain for the index since 2008. Those 5,105 contracts returned a profit of over $30 million overnight. To understand the precision of that timing, we have to look at the preceding week. On April 2nd, the administration announced its initial sweeping tariffs on all imported goods. The market reacted with one of the worst three-day drops since World War II. Trillions of dollars were wiped out from ordinary pension funds and retirement accounts. Then, the timeline goes quiet. On April 6th, Treasury Secretary Scott Bessent quietly visited Trump's Florida resort for a private meeting. No press, no public announcements. 3 days later, the $30 million anomaly hits the option chain. And minutes after that, Trump posts on Truth Social, "This is a great time to buy." The statistics don't allow for a middle ground. Either an anonymous trader made the single luckiest, most perfectly timed market guess in history, or they were operating with the kind of advanced knowledge that the rest of the market is never supposed to have. In 2012, Congress passed the Stop Trading on Congressional Knowledge Act, widely known as the Stock Act. It was marketed to the American public as the definitive legislative ban that would finally prevent politicians from trading stocks based on classified intelligence and unannounced policy. The text of the law reveals a different reality. If a sitting member of Congress makes a stock trade based on privileged information and fails to disclose it within the required 45-day window, the penalty is a flat $200 fine. It is not calculated as a percentage of their profit. It is roughly the cost of a traffic ticket. In the 13 years since the Stock Act passed, not a single member of Congress has faced criminal prosecution under it. This chart maps the average retail investor's annual returns against the portfolios of sitting lawmakers. Members of Congress, the specific individuals who sit on intelligence committees and draft market-moving legislation, outperform the stock market by an average of 12.3% every single year. Statistical variance does not account for a sustained, decade-long outperformance by hundreds of members across both political parties. If an ordinary citizen gets caught insider trading, they face 20 years in federal prison. Do you think a $200 fine for long enters is a loophole, or working exactly as intended? Let us know in the comments. The leniency of the Stock Act is not an accident of poor drafting. Within months of passing the original, much stricter version of the bill in 2012, Congress quietly introduced legislative amendments. Without the fanfare of the initial signing, they removed the requirement for lawmakers to disclose their trades in real time, pushing the deadline out to 45 days. Simultaneously, they granted a blanket exemption to congressional staff members, completely removing them from the transparency requirements. We do not need to guess if this system is being actively exploited. Lawmakers are legally required to file disclosure forms, leaving a paper trail of their activity during major economic crises. Representative Marjorie Taylor Greene executed multiple stock purchases on April 8, 2025. That was the absolute deepest point of the market crash caused by the initial tariff announcement. The very next day, the administration paused the tariffs, and her newly acquired positions surged in value. Attorney General Pam Bondi filed public disclosures showing she sold off her holdings in Trump media. She executed these sales at a high point, in the exact window before the April 2nd tariff announcement sent the broader markets and Trump media stock crashing. A Morgan Stanley broker intimately connected to Defense Secretary Pete Hegseth attempted to execute a multi-million-dollar purchase of a defense industry ETF. This buy order was placed in the weeks directly preceding unannounced United States military action against Iran. The trade only failed to clear because the specific fund was not yet available to the broker's clients. This is a calendar mapping the 7-day window between the initial tariff announcement and the market-saving pause. In that single week, members of Congress executed exactly 700 individual stock trades. These are public disclosures filed under the same law designed to prevent this behavior. Which of these 3 trades do you find the most suspicious? Drop your thoughts below. These case studies show a machine functioning exactly as designed, taking classified government briefings and converting them into personal, protected wealth. By April 2026, a full year after the 18-minute anomaly and the flurry of congressional trading, Senators Adam Schiff and Mark Warner formally requested an SEC investigation into the trading patterns surrounding the administration's announcements. 1 year later, the results of that inquiry speak for themselves. 0 criminal charges filed, 0 public subpoenas issued, no formal investigation publicly confirmed by the authorities. The total absence of enforcement is built into the architecture. The Securities and Exchange Commission operates with a budget of $2.1 billion to police a financial industry managing over $100 trillion in assets. Furthermore, the agency's leadership rotates continuously between government enforcement roles and executive positions at the exact financial institutions they are supposed to regulate. When an architecture of evasion operates without legal consequence, the behavior accelerates. Look at this cryptocurrency price chart from October 10, 2025. A single anonymous trader on the Hyperliquid exchange opened a massive 9-figure short position against Bitcoin and Ethereum, exactly 30 minutes before the Trump administration announced unexpected 100% tariffs against China. The announcement triggered the largest liquidation event in crypto history. That single, perfectly timed short position netted an estimated $160 million in pure profit in one day. You do not need to rely on conspiracy theories to understand the pattern. The specific trades are documented in public filings. The timestamps of the market entries are logged. The profits are recorded. And the total lack of criminal prosecutions is a matter of public record. It requires only basic arithmetic to see the system at work. Ordinary citizens fund their retirement accounts through decades of measured risk and honest labor. Meanwhile, a distinct class of insiders operates with a structural advantage, utilizing laws they drafted for themselves, enforced by agencies they staff with their own peers, to execute risk-free trades on information you were never supposed to have. Subscribe to the Prometheus Playbook to learn the secrets of the global elite.